Hi, everybody. My name is Richard.lesperance, and I go by the name of My Man Richard. Welcome to A Better Lifestyle. Today, we're having a roundtable on the real estate market. So I think you guys are gonna like it. So whoever's in real estate or wants to get into real estate, so they're gonna learn a few things. So I have four panelists with me. So I'd like for each of them to introduce themselves, say what you're doing and which type of real estate, and how long have you been doing it. So we'll start with Jen and Stacy.
Cool. You want to take it? Sure. Jen Conkey. I am a multifamily syndicator. I'm mostly in capital raising and been doing it since 2002, almost 2003. It was at the end of 2002.
I am Stacy Conkey, and I also am a syndicator. I spent most of my career operating multifamily. I started with single families and moved into multifamily, and then we moved into syndication more recently, and now into capital raising. So it's been, for me, it's been 20 years. 2003 is when I started.
Okay. Griffin?
So my name is Griffin Shermer. I'm located in Indianapolis, Indiana, and I specifically invest in mobile home parks. Specifically, what we do is we actually buy highly distressed communities. We clean them out and we put all brand new housing in. And we're running a business model much like an apartment complex, just with manufactured housing. I also run a retail business. So we build a lot of new homes all over Indiana.
Okay. Flint?
Hey guys, Flint Jamison with Vestus Capital. I'm also a syndicator. I do the multifamily space. I'm a capital raiser, and I partner with experienced operators in need of more teammates, really, both on the capital side, and I help out in asset management or other places. But I specialize in not only multifamily value adds, but I also do build to rent developments, which is kind of a new cool asset class.
Okay. So like I mentioned before, we're gonna talk about the real estate market for the year coming. So what's I'm gonna go do a review of 2023. How has it been the real estate market? Because I'm in Montreal, Canada. It's been slow, and it takes more time for a house to sell and all that. Buyers are holding down because of the economy, the interest rates, and all that. So in 2024, they still think it might bounce back, but that's on my end. So I'd like to know, definitely it has slowed down. I want to know on your guys' end, because I kind of listen like what's going on too in the States, but I want to hear from you guys. Maybe in different states it's different, but I want to hear what you guys have to say in overall for the year of 2023, and how do you see 2024? So we'll start with Jen and Stacy.
Well, I think in order to chime in on 2023, we kind of got to give a little bit of context beforehand, because it's slow, but there's also been all these interest rate hikes, and you really got to rewind back to like 2008 when the housing market crashed and they started printing money. So here in the US, they've been printing money since 2008, and whenever you're printing money, it leads to inflation. Around the 2020 mark, when COVID came out and there were the COVID lockdowns, we started to see a lot of issues with supply chain. We also went through an energy crisis. We went through a whole bunch of things, and they also started printing more money. So the Fed balance sheet went from about 4 trillion to 8 trillion almost overnight. And so when they're printing money like that, inflation happens. And then the Fed decided to course correct and start doing these aggressive hikes. It's literally, they did so many rate hikes. It was faster than they've ever done it in 40 years. And what happened was, during that time, like right coming out 2018, right before COVID and heading up into 2021, with all that money printing, what was happening is there was the absolute inverse of what was going on in 2008. In 2008, there was over 3 million homes in inventory. And nowadays it's less than 1 million. So you've got a lot of people who still need somewhere to live. But with all the interest rate hikes that have happened, there's not a lot of qualified buyers. So personally, I feel like right now is not the time to be flipping. It's not the time to be doing things like that because you just don't know what the value is going to be. And then on top of that, you don't really have a qualified buying pool. So renting is absolutely going to be necessary and continue to be necessary. And I think it's very fascinating. I can't remember which one of these gentlemen just said that the build to rent model. I think that's amazing. And I also am a big fan of the mobile home park strategy because there's a general lack of housing crisis in the US. And there's so many different strategies that are popping up to try and solve for that. But I think the biggest thing that I see heading into 2024, based on all of that and what's been happening, is there is about, 2,500 multifamily homes that are at risk of foreclosure in Q1 and Q2 in 2024 in the areas of like really good markets where the deals didn't pencil out back in 2020. So people started leaning towards bridge loans and taking floating rates. And they bought like a rate cap for 3 years, and that's coming up to expire. But they all went in at 3.5% interest rates or 4% interest rates. And now they're already at 6.5%, which they probably didn't imagine would ever happen, that they would ever hit that rate cap. And so they're upside down. And as soon as the rate cap expires, they're going to be in a world of hurt. So there's a foreclosure wall that's coming in the trillions of dollars in markets that are great markets. And the assets aren't foreclosing because the asset is not good. It's literally an issue with the financing. And these owners, the folks that bought in 2020, they're facing a really, really grave situation. And there's going to be a lot of foreclosures. So where I'm looking in 2024 is Arizona, Florida, and Texas. There is massive opportunity there. So I'm sorry for the long-winded answer, but that's just, I feel like there's got to be context to kind of tell the story. But that's what I see in 2024. And that's what our team is absolutely ready to pounce on. I don't know if you want to add anything there.
No, you got it.
No. Griffin?
Wow, that's a great summary. So I have definitely not been in the game that long. I've only been in since about the pandemic hit. And I can tell you in Indiana that just in this past year, we've built about half as many homes as what we had built during the pandemic. And it's been I've been hearing the same story, just people coming in saying like, I need a new house, but I'm locked in at 3.5%. Why would I build something new, sell my house, and now I'm going to be making a payment that's double what I'm making today? And I think you would probably hear that from a lot of people who during that time period, they were refinancing or they were buying something to get locked in at that lower rate. And it's been harder to sell because I think there's a lot of people out there who believe it will come back down to that. And I'm not sure that we'll ever see it come back to, 2.75 or even below 3.5. I just don't think it's possible. So from the retail side, we've seen a slowdown definitely in like our higher end product, but in terms of more affordable housing, like single wides, I don't really feel like that market has changed very much. There, like we all know, there is a huge demand for housing, and we're still seeing that on the affordable side. And we do believe that there is a lot more renters entering the market or will be turning to that as a solution, which is why we're doing something similar, Flint, like you're talking about the build to rent. I mean, we're basically doing that with manufactured housing communities, and we're buying properties that have been sitting vacant or they're filled with the people you don't want to be around, and we're cleaning them up, putting new housing in there, and basically following that model. And we are kind of pivoting more into that and away from retail because we're just getting huge traction with that business model.
I don't know if I'm allowed to chime in on that, but here's why I love that. The whole build to rent model, why I love that model is because you're coming up on Gen Z and millennials. They're not drinking the American dream Kool-Aid of buying your house and going to college. They're like, no, I want to rent. And so when you think about that population, that generation population in the US is very comparable to baby boomers. So right now, investing in retired assisted living, assisted living residential, that's a really good place right now to be investing because there's so many baby boomers that are going into it, right? And then you think about generationally that Gen Z, millennial is the next biggest group. So the build to rent, they're not drinking that American dream Kool-Aid. They're not going to buy a house right now. And even if they could, they can't qualify. So I really love what you two are talking about and what you're into. Sorry to chime in, but I'm excited.
Yeah, that's cool.
I need to bring you along to some of my investor conversations. You're giving the sales pitch pretty well.
It's because we're trying to raise capital for those, right? So I'm very educated in why it's smart to be doing those projects right now. I'm all about the mobile home parks and the build to rent. It's a great model. It really is.
Yeah.
So Flint, what's your take on the whole thing, 2023 and 2024?
Yeah, I'm going to try to avoid going down the build to rent because I am super geeked on it and I can talk a lot about it. But I also want to make sure that we divide single family homes, residential versus multifamily. They are two totally different games. Like 2008 was largely single family homes. The properties, the multifamily properties that were managed well, did well, because when you have people who default on their home, they don't just live on the street, they downgrade and they go into apartments. So there's this shift in the economy where people move between class A, B, and C apartments. And then if you graduate from a class A apartment building and move into a house, you go to a house. But there's always this up and down movement. And so multifamily tends to do fairly well. Built to rent fits in that multifamily, even though you're living in a single family home. It's like class A plus plus. But yeah, I'm going to try to take this a different direction because you guys already covered it really well, especially Jen. I think moving forward, I am not an economist. I am not someone that has a crystal ball that works. And so my philosophy and opinion as we move forward is always, I guess I care less about the macro market, because the macro market's going to move. The micro market's what matters and where you invest. You have to have really great a strong micro economy wherever you're going to invest, not necessarily what's happening at the macro scale. So Phoenix, that's where we're doing build to rent. Yes, Dallas, I think Florida. There's a lot of really great places to invest because the micro economy is in of itself super stable. It's growing. It has a diverse workforce. It has salaries that can afford whatever property you have and the rents that you're offering. So at this moment, yes, the economy is struggling. I personally am not struggling to have deals. My problem is investors. The investors right now are listening to the media. The media loves to throw out fear because fear drives clicks and views. So the media throws out fear. Investors end up sitting on their hands or sitting on their money, and the investor sentiment is very challenged right now. I think that is our biggest challenge as capital raisers and investors, to bring in the capital. There is a lot of very strong operators out there who are very creative, as in finding properties where you can get loan assumptions. The number of loan assumptions I've seen come across my desk that are picking up 3% interest on a 100-unit apartment building, that's the best way to get in. I don't care what the macro economy is doing. If the fundamentals at the micro level are good and you get a loan assumption at 3%, I mean, why turn your head away from that? But we're seeing it because investors are told things are scary. You got to wait for a better time. And I think that's our biggest challenge right now.
Do you think, well, not do you think, but is there any good deals now in these times? Jen or Stacy, you can answer that.
Yeah, I'll answer that. Yeah, it's funny because it's just like in any other time in real estate, it's a numbers game. What's for many, many years, when Jen and I started investing, we were not investing together at that time, but when we started investing, interest rates were at where they're at now. They're actually probably a little bit higher. Yeah. And so this interest rate thing is not foreign to us, but I think everyone got so used to them being so low that it's like, oh my God, there's no good deals. The reality is you have to underwrite the deals to what's going to make sense for what kind of cash on cash return that you're looking for. We have this year, we got a 96 unit that was seller financing. We have a 13 unit under contract that will close January 3rd. That's seller financing. We have a 48 unit that we're almost through due diligence with that will not be seller financing. That'll be a Fannie Mae loan. And the interest rate is higher, but it took a lot of relationships with a lot of brokers, a lot of conversations, and just reaching out, doing like quick analysis to be like, yep, nope. Yay, we found one that might work. Oh, nope, fell out during due diligence. And then you find one. So I think if people can wrap their arms around the understanding that just like any other time, it's a numbers game. It's just that because financing is the big issue right now and the interest rates, you're either going to pay way closer attention to seller financing, as we are and we do, and or you just have to find a really stellar deal where you can get a higher. I think the Fannie Mae loan was going to be, well, actually, it might go down. We were quoted 7.25. It looks like it might be lower than that, but even at 7.25, like it's still cash flows. It's not like the last several years, value adds have been like, that's been the darling because you can make so much money on the value adds. Your cash flow wasn't really so much of the big focus. And now, at least for us, me in particular, I'm super conservative. Cash flow is everything. Like the deal has to cash flow. If there's value add component to it, freaking great. That's like a bonus, but it has to cash flow based on the financing. And we will only do fixed rate financing, which has pretty much been how we've always operated anyway. Frankly, because Jen and I thought that this interest rate adjustment was going to happen way sooner than it did. We were literally stopped flipping in early 2019, because we're like, okay, I'm like, it's been too long. These rates have been good for too long. It's going to flip at any point. So we wrapped up in Bates Hendricks, we wrapped up the flips that we had going on, wrapped everything else into a rental portfolio that we had going on at that time. And we were just like, okay, it's going to happen anytime. I think if COVID hadn't happened, we would have seen, it probably wouldn't have been like crazy like it was, but we would have started seeing increases sooner. But when COVID happened, everything kind of shifted to try to save the economy from crashing. So it took longer before things adjusted. And when they did, it was a violent adjustment. But I think there are deals beyond just our own deals, because we have a multifamily academy. So we train and coach our students in deals. So even beyond, like, the benefit of that is even beyond what we see what else is going on. And there was a period of time where it was crickets. Like I was like, man, our students aren't getting a lot. They're getting a deal here and there. But now, and they're
just as of last night, there was at least 7 deals that are going on.
Exactly. Yeah. And they're not huge deals. Our focus in our academy is helping people start with like smaller deals, like, 10 to 40 units. But we have someone with an 11 unit, a 27 unit with seller financing, the 13 unit, the 48 unit,
22 unit.
The 22 unit, Maurice's 12 unit. Mm-hmm. So like there's a bunch of deals happening that are all either they're seller financed or they underwrote them conservatively enough that, it's not going to be the, 18% IRR that everyone got very used to during value add days. But they're solid places for people to put their money. And I think because of that, it's easier to raise capital because to Flint's point, it is hard for people that aren't like in real estate doing it themselves and they're just listening to the news. They are taking a step back. So one of the adjustments, we generally focus on smaller deals anyway. Under 50 is usually where we land. We do a few big ones, but mostly under 50, but mainly because of how difficult it is to raise capital. It's just so much easier if it's smaller. It's a smaller raise. People are taking less risk.
Close quicker.
They can
more.
Yeah, exactly.
Yeah.
So that's what we've experienced, that there are deals out there. It takes a lot of relationship building and a lot of just hitting it and believing I'll find it and not giving up until you do. And it's not just us, it's us and the people that we work with, and we're seeing it. So I know that there's good deals out there because we see them. We're in a few of them. And even beyond that, our students are getting them.
Yeah.
What about you, Griffin? How is it in your world?
I mean, I'll kind of piggyback off that. I bring a different perspective in that, I am somebody newer in the investing sphere when it comes to real estate. And I think it's a lot harder. Well, I mean, I don't know what it was like in 2008 or in the peak times. Like I was just entering, I didn't get that 2017 to 2020, market that people were really just, you could throw something and it seemed like you could make it work. But what I've found is, if you can seek mentorship if you can find people who found ways to be successful, whether the market was good or bad, there are good deals out there. And that's kind of what I've done. I've clung to people who have continued or done business the last 20 to 30 years who, they've been able to weather the different storms, and then just taken their knowledge and put my spin on it, because we're carving out our own niche within the manufactured housing space. I've done single family flip. I've built new construction. I've done small multifamily. I've rented single family homes. And I've decided that to just get one sole focus, it's actually a lot easier to find good deals than to just look at this big broad spectrum of real estate, because there's so much stuff out there when it comes to real estate. So I've carved out my niche. And we're doing stuff that we don't see a lot of other people doing. We know the larger investors are going after 100 plus unit deals. We're going after smaller things. I don't even focus necessarily on larger markets. We're going after smaller markets because even in a smaller town, it's like, can I fill 10 renters in this small little community? We're asking ourselves those questions before we go into deals. And then when you pair up having good mentors and people who are investing in you, I think you can make deals work no matter what the market's like.
Flint, you touched a little bit about that before when you were talking about looking at the situation, like the micro and all that. You want to add anything else to that in regards to finding deals?
Yeah, so my position as mostly a capital raiser, I found myself in this position serendipitously because I was working a full-time job. I designed aircraft for 20 years, which is why I have airplanes behind me, because they're awesome.
Cool.
But doing a W-2 job and doing this as a side gig, real estate as a side gig, I had to find my niche that I would be good at. And I didn't realize capital raising was going to be my thing. But why I fell into it is because I could do it remotely easily. The acquisitions, you really gotta be flying around. You gotta be face to face with brokers. There's a lot of on-site. You got to do due diligence. I love due diligence and inspections and all that. But you got to be on site. If you're doing something remote, it's hard to do that with a day job and really young kids at home. So capital raising, I was like, oh, this kind of works. And then I fell into with some friends, raised capital for them. And I was like, holy cow. So I brought my friends and family, your initial raise, to a deal with very experienced operators into a bigger deal. You get the economies of scale. And I'm like, oh, that's cool. So I kind of fell into that. And now I'm a capital raiser. So that long story short now is I am not the one chasing the deals. And I have established relationships with friends now that I consider friends. They're partners who are very experienced, and they do lots of assets across the country. Whenever they need help, they say, hey, Flint, can you willing to jump in and help us with this asset? I do my own due diligence. And so I'm not the one chasing the deals. And like I mentioned earlier, yeah, there's a lot of smart people doing deals out there, getting very creative with seller financing and loan assumptions. And heck, we just bought a 94 unit in Columbus, Ohio, that was 5.6% fixed interest. And that was new. Like, we went in and acquired that. I think it was a Fannie loan. And that was in May. So sweet deal in May of this year to get a 5.6% fixed for 10 years. I'm not the one chasing. It's just, I wait for the stuff to come. Now, capital raising is super hard, like I mentioned. So, yeah, there's challenges on all sides of the board, but at least I'm not the one fighting for the deals.
Are you, that's going to be Jen and Stacy, are you guys reviewing your strategies for 2024 in regards to what's going on with the market?
Oh yeah, we always do. Yeah. Every 90 days we do that. Yeah. We kind of cheated a little bit, honestly. We created this academy where we've trained everybody. We basically cloned ourselves as operators, because that's what we did for the longest time. We were operators. So we taught everybody how to do that in the academy. So we've got hundreds of people in the academy that will go find those deals And then at a certain level, they also, a lot of them know how to do the asset management. But we get a lot of deals dropped in our lap just from our students. And so our strategy going forward into 2024 is we're trying to create a team. Like we have a vision to create an army, and I want 300. You'll always hear me say that. I want 300. I want 100 teams of 3 that are out there doing 2 deals a year. And we're creating that inside of the academy. So 100 acquisitions managers, 100 capital raisers, 100 asset managers. And if they're all doing 2 deals a year, then that's 200 deals that we can go fund and figure out how to fund that. And we're also, Hunter Thompson is our coach. He's our mentor when it comes to capital raising. We're part of his mentorship. And so we're also exploring creating a fund of funds. So we have a whole strategy on that, because as Flint mentioned, one of the best things that you can do for yourself is not be the one that has to find the deal. So the deal is brought to you, you figure out how to fund it with your network. And then you don't even have to be the one that manages it. You check in, obviously, you can know how that asset is performing because of your investors and being able to interact with them. So our strategy is to do exactly that, raise a whole bunch of capital. We're literally having weekly meetings with our students that are raising capital. It'll probably turn into a daily huddle, but we have a goal to hit 10 million capital raised by the half mark of the year. And maybe even go so much as, dare I say, to 50 million by the end of the year, capital raised. Because I want to,
this year,
you get wealthy by going deep into one thing, right? Like you do the one thing to get wealthy, and then you diversify to protect the wealth. And we're just at a stage in our life where it feels like if I can find solid operators that are doing mobile home parks, solid operators that are doing the RV parks. We have an RV. We love that life. Like that is fun. So it also hits home, and then, or the build to rent. Like if we can find solid operators where we can bring capital to those deals in a niche that we are not experts in, but we could more than likely come in, analyze and figure out, do our due diligence, because we're pretty dang smart at that. But we can get into different asset classes without having to be the expert. And if there's one thing that we have, it's a huge network that we can bring to that. So our strategy is exactly that, to be able to bring capital to other operators while still developing our operators within the academy. And we're not really taking down deals ourselves anymore. Instead, we are in more of a consultative role in those deals. And it frees us up to go raise the capital to continue to scale and get the cash flow, the equity, fees, and all of that, so that we can learn how to do this fund to fund models the right way. Because it's
so. Are you? I love this, by the way, and I think we can geek out about this for. Well,
let's geek out. I would love it.
We'll see if Richard wants to take how far he wants to take it.
No problem.
So I come from the Good Egg Real Estate Accelerator program. I did that a couple of years ago. But what they Julie and Annie ended up doing was their specialty as far as coaches was capital raising, and they can raise $30 to $50 million on a single raise. And then they turn around and started coaching others how to do capital raising. Here's the systems. But in doing so, they created this army of capital raisers.
That's what
they're like, oh, all right, well, let's open it up for fund to funds. So I created a fund to fund. Actually, my second capital raise. I was like, you mean I can do a fund to fund and jump on your portfolio of 3 properties with 720 units, 2 different states, 3 different cities?
Right.
Class A, Class Bs. I mean, it was like, yeah, let's do that. And then I grabbed some of my friends who were also in that as capital raisers. And I'm like, look, we got to hit a threshold. Got to do $1 million. Maybe we can hit 5 million. Let's do it. And so we did it. And yeah, the fund to funds aren't too hard. You gotta kind of know what you're doing. I learned a lot doing that, but it is an easy way to scale, and it gave, like you said, your investors are now getting this diversified portfolio. They're getting in with experienced operators. There's a lot of very smart people involved the bigger it gets, and I think it just de-risks the situation even more.
1000%. I love to geek out about that stuff, and I'm definitely.
Are you guys also KPs? I assume you're KPs, or are you the guarantors?
No, we are not the guarantors. No.
Oh, okay.
The only ones that we've ever that will sign on the loan is literally only if we are the operators.
Right.
those just beyond my risk tolerance, signing on a loan for anyone else.
Yeah.
But even with that, like any deals that we do, for many years, we did not do any deals with our students. We needed to make sure that they were far enough along and we could watch them for a few years and see their character. How do they operate? Are they meticulous? Are they careful? Are they conservative? And so we'll advise them and we will help them. And, we have 20 years of experience. So we can see a red flag miles away that someone new or doesn't even know exists yet. So that's what we bring, but we will not sign on a loan that we are not the ones doing. And like, it's just, I don't know. We have 4 kids. It's like for us, a lot of it, we have 4 kids. We have a lot to protect. And we have a lot of people relying on us and all of our students and all of our staff and everything else. But another reason that we really decided to start niching down into, because we still do some operations, but it's mostly in the advising way. So it doesn't take a lot of our time, but we really had to niche down from a time perspective. Like we just don't have that much time. We have kids that are now between 9 and 12 years old. So now they're getting almost to be a teenager years. And there's 4 of them. Yeah. And we have our academy and our portfolio and we're continue to acquire. And it's just like, there's only so many hours in the day.
It was almost easier when they were younger. And we are the remote multifamily investment academy. So we've never been to any of our properties until last year we didn't even go inside of them. We rode bicycles around and we're like, oh, look at that. But it was easier to do it back then when they were younger than it is now. Now it's like sports and they do this and there's all these things. So it's like, there's just no bandwidth. There's no bandwidth to go do those things now that they're older. So I agree. It's like,
so that was because I enjoy, and even in the academy, we teach our students, like, you got to know all of it. You got to, well, at least for me, I was like, as a teacher, I'm like, you have to know all of it. You got to be able to do all of it. But the reality is, as you start growing your portfolio, coming up with a specialty, because I love acquisitions. I love due diligence. That's my total favorite thing to do, but it is time consuming. So I'd like to advise on it, but I love doing it. But the capital side allows us to get into the most deals, and we still underwrite. We still do our due diligence on the syndicators underwriting. So it's doing a certain level, but it allows us to get into more deals with less time. And the operation side of things is very time consuming. And you're just constantly always in it.
It's another job.
It is another job.
I mean, let's be honest, capital raising is a job in of itself, but having to be on site a lot is an extra level of job. You got to travel to it. You got to be there. You got to sit down in meetings. I'm glad I've serendipitously found myself as a capital raiser because I'm an engineer and I am not a salesman, but it seems to be working out okay.
That's interesting. I did not know that capital raising as a thing by itself was a thing until about 1.5 years ago, because we've always just funded our own deals. I don't mean like it wasn't always all of our own capital, but we just do joint ventures.
Family and joint
we would just be like, you want a couple partners, or we would take down the deal. And that we were able to do that because our deals were, on the smaller end. But I was like, wait, what do you mean capital company? What does that mean? So that was like, that opened up an entirely new world, which is allowing us to not only build relationships with people, but get into markets that we wouldn't have been into otherwise, into larger deals with economies of scales that we just didn't have time to even go that route. So it's been, this newer for us business has been amazing for expanding our knowledge and our network and our real estate friends.
It almost feels like we're bending time,
Yeah.
Which is cool.
Griffin, are you reviewing? You want to add something to that?
Listen, I'm over here taking notes because everybody is definitely at a whole nother level. Everybody is where I'm trying to get to. I'm in that phase where I'm raising the capital. I'm finding the deal. I'm building it. I'm doing it all right now. And it's just funny to listen to everybody else talk because I know this is where I'm going. My biggest revelation and strategy in the last 90 days was, hey, I should be networking with wholesalers because they're constantly looking for giant deals or deals for people. And they probably come across stuff that they don't even know what to do with because who's buying abandoned mobile home parks? So I now have a network of wholesalers. I'm getting deals coming into me week after week. And I'm actually next week sitting down with some investors to talk about, hey, how are we going to raise $10 million? Because I've got these giant deals ready to go now that I know I can tackle. And now I have all this deal flow. And now it's like, all right, where do I get this capital from? How do I, a fund of a fund, like that's a revelation. So I love it. And it's like, I think if you're just constantly trying to improve, if you're not constantly improving, I think you're falling behind. And yeah, this is enlightening. I'm going to write down a lot of stuff after this is over because this is great.
You're setting yourself up in such a great way though, because you're doing all of it. You know what it takes. You know what's easy. You know what's not. None of it's easy. But it's almost like what you've created through your wholesalers is like your acquisitions team completely. But the fact that you don't have to go find the deals and source the deals, it's time consuming. So you're already working your way there. That's amazing, especially since you only started in 2020. Like, that's incredible.
Well, thank you. Yeah, it's I've just been trying to like find ways that's not going to cost me millions of dollars. Like, how do I, come up with a solution until we get big enough that we can start bringing a lot of people on? Because we finally hired our first person. We've got 2 more people we're looking to bring on. And it's just like, you're trying to put all these puzzle pieces in place. And when you've never done it, it's scary, but it's exciting. Like, I'm willing to take the risk to go for the upside of it.
So Griffin, so at a young age, you're 26, I believe. Yeah.
Yeah. Yep.
So anybody at that age, not too many people, I don't know, like maybe they're in real estate and doing what you're doing. It's obviously inspirational. So what would you say to someone who wants to go in that direction because of the age factor? So what would you say to them?
Well, I would say the best thing you can do is try and find a mentor. I mean, that's what I've done. There's a lot of people out there, Jen and Stacy, you've been in the game for over 20, however many years you've been in. Like, I'm sure I know it brings my mentors joy that they can help somebody young who wants to keep going and doing what it is they've done for so many years. And when you can go and show them the hustle and the dedication and what you're willing to do, I mean, I'm already, owning millions of dollars of real estate. If you'd asked me that 3 years ago or 4 years ago, I'd have been like, I don't even know what I'm doing with my life yet, let alone doing something like that. But there's so much because of the internet and what we have today. There's so many resources where you can start reading and listening and, getting on podcasts and finding books. And like, I commute back and forth all the time. Like, I drive to communities all over the place. So when I'm driving, I'm listening to a book, I'm listening to a podcast. Like, I'm trying to get better at what I'm doing. So I don't think you have to jump right in. Like, I spent over a year educating myself before I did my first deal. So like BiggerPockets is where I started. I think that's a great place. It has tons of resources where you can find things that there's a huge forum there of people who've asked all the questions that you could ever think of. So I don't think you can find an excuse. I think there's just so much information out there and so many ways to do it. Just start somewhere.
So what about the financing? How was that for you?
Well, once again, like finding a mentor and, once you start learning, about real estate, you're able to go find great deals. And if you can find great deals, the money will follow. That's what I was told. And that's exactly how it went. Once I found a great deal, I talked to my mentor about, hey, who do I go to? And guess what? They have a list of people already that they're like, hey, I bet you could sit down with this person with this person. Like, you only need one person to say yes, you can get 100 no's. So I didn't start with any money. It took us a few pitches before we had somebody who would say yes. But once you get, the hardest one is your first deal. I mean, I think anybody would say that. And after you get that first one, it just, your confidence in what you're doing and getting to the next level, it's a lot easier.
So in that direction,
the law of the first deal.
Yes,
Exactly.
so in that direction of financing, any creative ways like to get financing for people who don't have the capital to start in the real estate, or even like while they're in the real estate, like to grow more, to be more creative in getting capital? I'll go with Flint.
To get capital.
Yeah, to be more creative.
So one thing I'd like to put out there though is my first deal was a failure. We had to back out mostly because we couldn't raise the capital. And I ate the earnest money on that, which is painful. A lot of lessons learned, but I say I got the law at a half deal on that because what happened in that, I not only learned a ton, but from there, I was like, I know exactly what we did wrong. And we didn't have ourselves prepped to raise capital. We thought we went with the, if you build it, they will come strategy. And even though a bunch of places on the internet tell you not to do that, or books or podcasts, we did it. Dumb. And we lost. So I turned around and immediately it was like, all right, I'm paying for coaching on capital raising, hence where the real estate accelerator program came in. And within 3 months from that failure, I got invited on to raise, and I had a successful raise, and we went from there. So one, act cautiously. It's not that if you build it, they will come. Even if you have a great deal, you don't have an investor base that's going to immediately flip, because you are likely to just talk to new investors or family members that have no idea what you're doing. Even if it's a great deal, they don't have it, or they don't have their head wrapped around it yet. So you have to build that network first. Your first raise, I don't know about you ladies, Jen and Stacy, or well, even Griffin, if you've raised money. That first raise for me was, they said, can you bring 500? And I was like, I'm not going to promise 500. I will bring 250. And if I make it to 500, that'll be cool. And I actually got that from Hunter Thompson. He's like, never promise something you don't think you can get. That was right in his book. And so I took that methodology and I approached them. They were like, all right, well, let's try it. And so I hit my 250. It was a grind. It was super hard to get there. But that is a normal story for most capital raisers. There's a few of the unicorns out there. I have a friend that's a unicorn. His first raise, he raised $1 million. Then after that, he raised like 10 million in his first year, which is pretty crazy for most investors. But now I say, yeah, act cautiously. Act like it's super hard to raise capital, especially right now. So you need to get the right friends in place who could raise capital, who have an investor base that is already warm for that asset class. Like when I knew I was going to start raising for build to rent, I started warming them up for months to get their head wrapped around it, what it means, what it is, what are the risks, because I can't just present a great build to rent deal because they're not going to convert. So there's a lot of effort to get there.
Jen, Stacy?
So it was the question of like what creative things people do when they don't have capital to start? Yeah,
exactly. Creative ways.
So when I was brand new, I did not have capital. My credit was like, and I had, maybe a couple $1,000s, nothing to speak of. And when I started going to investor clubs and talking to people, and I had invested in my education, I spent $40,000 to get an education. Education was absolutely awful and didn't set me up very well for success at the time, but I knew a lot of stuff and I was exceptionally enthusiastic. I had enthusiasm like bursting out of me. And I was so excited. This is exactly what I'm doing. And so I'd come to these investor clubs kind of thinking that everyone else was in that same place. Like everybody was super knowledgeable, done a bunch of deals, but that wasn't the case. What I found was people that I was around, they all wanted to do real estate. Like they knew real estate was the way to go, but they didn't know how, and they had not invested in their own knowledge and education. So as I started talking to people, I started realizing, oh, wait a second, I can actually produce a solution for them that will be a solution for me. And so I started, it was many years before I even knew what it was called, but I was basically doing joint ventures. So I would, find someone and we start with, a duplex and they'd put up the money and I would, handle the transaction and we would partner. And then I'd get another one and find another partner and started doing that. And then as we grew into more apartments, like smaller multifamily, we just use that same model. It's just that now it would take a few people to do a deal because the numbers were bigger. So the biggest thing that I always tell people when they're getting started, like don't be hung up on whether you have the capital or not, because even if you have $1 million of cash sitting in your bank, that's gone like that. One deal or two deals, it's two smaller deals, you're going to use it. So you always want to be thinking, if you are in the business, like for the long term and you want to scale, it is all about building relationships and recognizing that. And I'm not saying it's easy right now, because during hard economic times, it is more difficult. But as you look at a more global view, there's so many people that know real estate is the way. It's not like it's any secret that the majority of millionaires have been made through real estate. So like, it's fairly common knowledge. So even if someone doesn't know a lot about real estate, they usually know that that's how you build wealth, or that's one way to build, like probably the best way to build wealth. So if you can, I think when people don't have money, they don't think about it from the standpoint. When someone is very, very busy and they have capital, but they don't know how to do it, and they don't have time, and they don't even realize that they could if they wanted to, or they don't want to, they need someone that can actually help bridge that gap between they have capital that's literally dying in the bank. It's like wasting away from inflation, and helping them get into a deal. And if that person can be the one that provides the deal, I'd speak more with joint venture, but this goes for capital raising, also. But in a joint venture, if you're the one doing the deal, you don't have to have the money. If you can come from the place of service, like, cool, I'll be the one to pound the pavement and do all the work. And if you could be the one who's my partner in the money side of it, we can both win. I'll win because I'll get the deal done and I don't have the capital. You'll win because now your money will be at work and you'll own real estate and you'll get cash flow and equity and depreciation expense and all of the benefits that come with it. So that's, Richard, I think that's my biggest, we have to do so much mindset work with our students when they're new, when they have, because no matter what, they always have some limited amount of capital. Even if they come in with a lot, it's limited if you're trying to scale, no matter what. So that's really the biggest mindset shift that we have to make for people. And it came for me really early because I did not have money and I didn't know how I was going to do it, but I was so enthusiastic that it hadn't occurred to me that I couldn't do it without. And I just ended up partnering with people. And those people would always come back and just, they had so much gratitude. They were like, oh my God, thank you so much. And I was like, thank me, thank you. I couldn't do the deal without you. And they're saying the same thing. I'm like, but I couldn't do the deal without you. And I was like, oh, and so thankfully I learned that lesson really early. And that's just the message I always try to give new investors or people coming in, so that they don't come with the mindset of, oh, I can't do it because I don't have money. Yeah, yes, you can. If you'll be the one who does it until you have the money, then you move into a different realm. You will be able to fund your deals and you'll help other people. It's not about, like, the biggest hang up for people is like, oh, I'm afraid to ask for money because I don't want to seem needy. And I absolutely get it, because I can appreciate feeling that way. But the reality is, it's not about you needing money. It's about you have a money-making opportunity and they could not get into that deal without you. You can't get into the deal without them either. So it's really a synergistic opportunity for a win-win. And if people can shift that mindset to, we're going to partner and we'll make money together. If you don't have the capital, cool, then you're going to be the one doing the work. That's just how it is. That's called paying your dues. And we were in that position for a long time, and now we're in a different position. That's the biggest thing. It's not even that creative. It's just having a mindset of, let me help other people get into real estate by letting them partner up with me, and we do the deal together and we both win. It's a win-win.
Jen, you'd like to add something to that? Or...
I think that, yeah, I will. My experience, I spent 22 years in corporate America while doing real estate on the side, right? And during that process, one of the things that I learned is that everybody's got their money in 401ks, retirement accounts. And I always would encourage people, you got to think outside of the stocks, if you will. And when you look at what assets produce the most returns over the course of history, real estate is always the highest contender, despite the 2008 crash. But again, that was single family based, and I'm talking about multifamily now. So if you can delineate those two and look at how multifamily, people always have to have somewhere to live. And in these times, it's kind of like what Flint said earlier, when people are forced out of their homes, or they don't have anywhere to live because they can't buy a single family home, they're going to be in apartments, or they're going to be in a rental property. And that's where it's still going to thrive. And during that time when it's thriving, watch the stock market. It's very volatile. And they also, if you look at network news, it's horrifying, but you can put up 40 different screens of newscasters saying the same exact words at the same exact time, word for word, because Flint is absolutely right. They are trying to drive fear. And so I always advise people, like, don't watch the headlines. Don't make your decisions based on headlines. Go look at the facts, look at the patterns, look at the trends, make distinctions, and then determine, what do I need to be doing instead? Because, the sky is not always necessarily falling at a micro level. It might be at a macro level, but there are pockets where it just makes sense to get in. And I like to look at people's retirement plans per se. And if it's heavily weighted on the stock market, I am not opposed to just kind of exploring that. It's like, do you want to go broke slowly? Or do you want to try and maybe stop that bleeding and make it rain and do something more consistent? And it's just really trying to shift their vantage point on what's possible. Because a lot of people think that they have to be at that 9 to 5, which is really a 5 to 9 for 30 years to get the gold watch, retire, and then do all the things. But that's not 1950 anymore. And the stock market is always going to be doing this because the headlines drive it. And it's like, there's a whole thing, right? But real estate always performs. 90% of millionaires became millionaires through real estate. And it's just a common fact that everybody knows. So I like to think about, what else could you be doing with your money instead of putting in this 401k, which, by the way, is just helping you go broke slowly.
I here talking about creative ways to raise capital. I got most of my investors from LinkedIn over the past few years, and those contrarian posts about 401ks and retirement accounts get attention. And what's crazy is you get attention from those who are like, you plant the seed in their ear and they're like, oh, tell me more. And then you get the ones that are the fun ones who are like, no, it's perfect. It's designed to allow me to retire at 59 and a half with a great retirement. And you're like, really?
Yeah.
How many people do you know who retired at 59 and a half with a great retirement versus all the people that are still working because the 401k didn't do what it was supposed to? Exactly. Oh, and by the way, the father of the 401k regrets creating a 401k because the financial institutions took advantage of it.
Yeah. When they're drinking the Kool-Aid, it's hard, right?
Thank you guys for being here. I think it's on the 1 hour mark exactly. So I'm gonna wrap it up. So thank you guys for doing this panel with me. I really appreciate it. I hope everybody found some value in it, and they're gonna apply what they've learned in that roundtable. So on that note, thank you everybody for taking the time to listen to the podcast. Welcome to A Better Lifestyle. My name is Richard.lesperance, and I go by the name of my man Richard, and we'll see you on the next episode, everybody. Bye, everybody.
Thank you.
Thanks, Richard.
Thanks.
No problem.